on News Live.
Welcome back to Switzer. It was a year that many stock investors might like to forget. The ASX 200 only rising 1.17% in the financial year that's just finished. But as always, the devil is in the detail. So let's have a look at how Australia compared to some of the overseas markets. Joining me to work through those numbers, David Buckland, CEO of Montgomery Investment Fund. David, thank you so much for joining me. Now, that's a hideously disappointing number, isn't it? 1.17% for stocks over the year, obviously dwarfed even by the property sector here in Australia. Why do we continue to underperform?
A number of reasons, Carrington. The first reason is that the configuration of the Australian market. It's primarily about 45% made up of financials and about 15% made up of the material stocks. So if those two sectors are not firing, the Australian market is in all sorts of trouble. And what we saw on the material side is obviously a pretty serious bear market in commodities, with the prices of things like iron ore, oil, coal and copper, and even gold not really performing, but most of those commodities doing quite poorly. So that really hinders the metals and mining side of our market, which accounts for about 15% of the market. On the banking side of things, what we had was long bonds all around the world sell off, and what that simply means is that the yield increased. So, for example, long bonds in the US went round figures up by about 70 or 80 basis points in the most recent 3 or 4 months, and that really does pay quite negative attention onto interest rate sensitive type businesses, and the banks also got quite hurt in the latter part of the fiscal 15 financial year.
Well, is there any reason to be optimistic? We keep hearing the commodity crunch will continue for the foreseeable future. No major turnaround there. People are telling us that the banks are going to have to bring on more capital as we see requirements shift there. Potential financial contagion if we see Greece perhaps leave the Eurozone. Such a big part of our market. Is there any reason for Australians to be playing within the ASX 200, do you think?
Look, I think it's been very, very well supported by record low interest rates. We saw cash rates down to 2.25% in the month of February, and then reduced further to another record low to 2% in the month of May. And so that is generally quite supportive. But what we also saw is a corporate confession season where we estimate there were at least 2 downgrades for every 1 upgrade. The problem with the downgrades is a lot of them were quite large companies, and a lot of those downgrades were substantial. So the upgrades really were confined to relatively small, not important businesses when it came to the sort of the points on the general market. So that is definitely a headwind that the market is fighting against, Carrington.
Is the silver lining perhaps so, David? Confession season is serving its purpose. We're getting rid of all the bad information now. That'll be fully priced in. So when we actually hit reporting season, it should be upside. Is there any optimism there?
Look, that's a good question, Carrington. But what we have to do as analysts is we have to ask the question, is this corporate confession season full of stocks that are making confessions that are now becoming structural and more permanent?
Right.
Or are they just simply temporary and cyclical? And if they're temporary and cyclical, so for example, is Seek with its education division temporary and cyclical, then the stock, when it sells off quite dramatically, becomes a buy. However, if it's a Slater and Gordon, possibly a Woolworths, one asks, is this actually structural and relatively permanent? And then I believe it's just better to avoid those sorts of situations. On the global front, Carrington, it's very important to point out that those people who were lucky enough to invest internationally 12 months ago, you know, enjoyed not only a approximate 20% depreciation of the Australian dollar, assuming they stayed unhedged, they also enjoyed some markets such as the Shanghai Composite Index, which was up 108 percentage points over the year. The Nikkei 225, which is a Japanese market, was up 33% over the year. And even our friends in parts of Western Europe, such as the DAX, 13%, the NASDAQ, which is obviously the American technology index, also up 12 or 13%. And here we had a capital return in Australia, of course excluding dividends, as you quite rightly said, of between 1 and 1.5 percentage points. So those people who have gone offshore in the last 12 or 24 months have definitely been outperforming our domestic market.
Well, what I thought was interesting, when we saw these numbers at the end of the financial year, we also saw what the expected superannuation funds were. And for the year, I think it was about 12% they were expecting on a balanced fund. And that was because of exposure to overseas markets as well as exposure to the rampaging property market here at home. But I guess my question, though, is Australia seems to have underperformed since the GFC. And we keep hearing year after year that, therefore, it probably means Australia is about to fire, that will follow the American lead. It's about to happen. But it just doesn't seem to have occurred. Yeah. And now all the signs are that the Australian economy is underperforming what we're seeing in America. So is there any reason to be optimistic that we will catch up?
I don't think so. And I just take up a point there, Carrington. The Australian market actually did really well 2009, 2010, 2011, 2012, and it had a massive pull-up effect from China. And as you may remember, things like iron ore did bounce very hard after the GFC, as did a lot of commodities. It was really just been the last 24 months when the price of iron ore we've seen it crash, oil crash, coal crash, even copper's come back quite dramatically, and the $8, as we know, has come down from well above parity to sort of 75 to 80 cents. So it's really just been the last 24 months, in my opinion, when the Australian market has become a bit of an underperformer. And as I said, there's been pockets globally, primarily through very aggressive quantitative easing in Europe, nil interest rate scenarios in most other Western world countries, where through both depreciation of the Australian dollar, some of these offshore opportunities have just been a lot more appealing.
Yeah, okay. Well, let's have a look then around the world and see if we can see where there's value to be had. As you pointed out, we've seen Shanghai in particular run crazily high over the last year, hitting up to 150% return at one point, pull back significantly since then, I guess demonstrating also the volatility in that market and maybe not for the faint-hearted.
Certainly not for the faint-hearted. It's a highly leveraged type business. You've got taxi drivers punting this like there's no tomorrow. So, as you quite rightly say, Carrington, this is certainly not for the faint-hearted, this market.
So when you're now looking at the assessments, I know you use a different type of valuation method when you're looking at stocks, and maybe you're not as interested in how they've necessarily performed over the last year. But do you start to get worried if you've seen too big an increase? If we look at the Nikkei 225, has that been too strong a growth in the last year for you to think there's value to be had there?
No, not necessarily. What you try to do all the time as good investors rather than speculators is look at high quality businesses where the business model is on the improve and the environment which that company is operating may be on the improve, not necessarily deteriorating. So, for example, Aldi versus Woolworths. Aldi tends to be, from my humble opinion, being on the improve. Woolworths does not tend to be on the improve. So Aldi is not a publicly listed company. It's owned by German families. It's effectively a debt-free business that uses cash flow to expand in Western world countries such as France, the United Kingdom and Australia. But it seems to me, if you just compare the two, one is a business model that's going north, one is a business model that is not going north. And as investors, that's what we're trying to find, is we're trying to find business models that have a very, very, very solid tailwind on a 5 to 10 year view, rather than just, as I say, just sheer speculation.
Okay, so when you're looking for these companies, do they tend to be geographically concentrated at the moment? Are you seeing them, for example, more in the American space than you are in Europe? Europe, we have all these headwinds as far as the potential Brexit. We don't know exactly what the shape of the Eurozone is going to be in a year from now. Does that play on your mind when you're looking for these value companies?
No, not necessarily, because we've got a situation in Europe where there's enormous quantitative easing, and that's announced to go on till at least September, October 2016. So that will be highly stimulatory for a very, very high quality industrial company in, for example, Germany, France, Scandinavia, possibly even the United Kingdom. So it's very much a stock by stock basis, rather than just sort of waving your wand and saying should you be long area A or area B or area C. So what we're trying to do at Montgomery, and particularly with our Montgomery Global Fund that was launched yesterday, is find you know, you only have to get 24 stocks with really, really high qualities, really, really good prospects, and most importantly, most crucially, is buy them at a price less than USS to be their intrinsic value. And if you do that, over the medium to longer term, you'll add much more value than the overall market.
David Buckland, we're going to have to leave it there, but thank you for joining Switzer.
Thank you very much, Carrington.